Hey, Lauren here at Aggressive Credit Repair. Want to talk about my upcoming newsletter that focuses on interest rates. Everybody knows they're going up, but what does that mean for your mortgage payment? I'll take my face out of here while we focus on that. Well, it actually is pretty substantial. Okay, I've got two charts here. One is more detailed down here, but let's focus on this one. Okay, rates right now around this area. I mean, they can fluctuate, but let's just, for the sake of the conversation, hypothetically say that a 30-year fixed mortgage for an FHA loan is going to be 4.5% interest. And let's say, for the sake of the conversation, you're going to get a starter home. That used to be an expensive home 10 years ago, but the starter home for $300,000. Okay, where does that put your payment at 4.5 interest rate? $1,520. Okay, well, let's just say, for this example, your rates go up, or your credit isn't so hot, and you have to pay a 5.5% interest rate on that same mortgage. Your payment will go up $183 in this single example. So you can say that 1% interest on a 30-year fixed mortgage with respect to payment and interest only is going to cost you, in this example, $183 more just with the increased interest rate of 1%. And if you go down here, I've given you a bunch more. And if you starting to get into, your second home and a fancier home, and I mean, look at this, the difference between a 3.5% rate versus a 5.5% rate. It's like $800. Okay. So yes, interest plays a big role. And if you times that by 30 years, it's a lot of extra money you're paying. Now, the $1,000,000 question is, well, if you're trying to get your starter home now, should you wait for prices to come down on real estate while interest rates go up? I don't know. That's a game that's risky to play. I always say get into a home loan as soon as you can to start building equity. But these numbers are another way to look at it, and it's certainly something to consider. Thank you for watching. Until next month.